All right, all right, all right. Welcome to the Annuity Researchers Podcast. I am Zach Van Ness. With me is Matt Sluizer, um, and we are senior annuity advisors here at Annuity Association. Matt, go ahead and introduce yourself.
Hey, everybody. Thanks for joining. I'm Matt Sluizer. As Zach mentioned, a senior annuity advisor here. And this is the first episode of a new series, the Annuity Researchers. We'll be delivering independent, unbiased reviews of today's top annuities in the marketplace. And Zach's going to go ahead and introduce our first annuity that we'll be reviewing.
Yeah, so really our mission here is to provide a better annuity buying experience at Annuity Association. So what we found is that we want to jump in, take an unbiased review of products. That's why we're launching this series. So today what we're going to do is we're first going to break down Delaware Life's Truepath Income, new product to the market, getting a lot of buzz. We're seeing it pop up here quite a bit in the research that we're doing. This is a fixed index annuity designed to provide retirees with customizable guaranteed income and unique growth options as well.
So before we begin, just a few quick disclosures. Keep in mind this video is for informational purposes only. It does not constitute legal, tax, or financial advice. The rates and features of these annuities can vary by state and are subject to change at the carrier's discretion. And the materials that we'll be using in the review are not intellectual property of Annuity Association. So please consult with a licensed financial professional to determine if this strategy fits your goals and financial situation.
All right, so let's jump on in. Matt, can you see my screen?
I can.
Okay, so pulled up the actual product brochure for Delaware Life. So we're going to take a closer look here. And what we'll do first is we'll jump into a little bit about Delaware Life, and they happen to have it on this page here. So I'm going to zoom in here to where we want to focus in on at the beginning. All right. So Delaware Life, technically established in 1971 and then rebranded as Delaware Life in 2013. They are part of Group 1001, a financial services company with actually over $60 billion in assets under management. They hold strong financial ratings, including, as you can see here, an A- rating from AM Best, S&P, and Fitch. And they are backed by a stable ownership structure. Diving in a little bit more, unique factoid here for you. Delaware Life actually launched the first fixed index annuity nearly 30 years ago. So the first to come out with a fixed index annuity. Matt, what we were talking offline here, what was the name of that?
So it was the Keyport Key fixed index annuity that came out in 1995 under Keyport Life.
Awesome. Yeah. So Keyport Life prior to becoming Delaware Life. Yeah. Awesome. All right, Matt, I'll let you take over.
Yeah. So let's take a look at who would this annuity be a fit for. And there's actually a nice page that breaks it down here in the brochure. So according to Delaware Life, the Truepath Income is ideal for three types of clients. You have the every investor, so that would be someone that's really seeking safety. They're looking to safely grow their money and have flexibility for the potential of a future income stream. And then you have the late saver. So this could be someone that maybe is in their 40s or 50s. They're catching up on their retirement savings and they're looking for a strong income stream to help to supplement their other sources once they do retire. And lastly, you have the red zone investor. So this would be someone that's really in that 5 to 10 year range, either leading up to retirement or after retirement, where they really want to make sure that they have safety, they're protecting their nest egg, safely growing it, as well as have a strong income stream available.
Yeah, so to be clear, hence the name Truepath Income, this annuity's purpose is for the intention of lifetime income. So if you're seeking short-term liquidity or speculative growth, this may not be the right tool, but for long-term guaranteed income, this is a very strong contender that we've found here on the market so far. So going in a little bit more, this is a fixed index annuity. Just zooming in here on this specific line here. This is a fixed index annuity, which can help counter the effects of inflation and maintain your purchasing power by combining growth potential and premium protection. So what Delaware Life has done is they've gone a step further into adding 2 income growth and 2 income distribution paths to utilize this product in a couple different ways. So we'll take a closer look at that. And just to be clear, as we go in, we'll find a key term here. That's the built-in guaranteed lifetime withdrawal benefit. So that's a separate calculation. So this gives the retirees the ability to grow and customize income while maintaining that downside protection.
And if you're new to fixed index annuities or the concept of lifetime income riders, make sure to check out our other episodes where we'll break down how they work and the common structures, and we'll include links to those in the description. So make sure to check those out.
Yeah, so let's dive into one of these paths, if you will, of how we can take this journey. We'll actually take a quick synopsis here of the 2 strategies, but the ready strategy is what we'll take a look at first. This ready strategy is taking a different approach in that somebody who may be looking for income sooner. The way it's taking this approach is, number one, first of all, how that income is increasing. It's increasing by a 25% bonus to that income calculation. Just to be clear, that 25% bonus is applied to the income calculation. It's not applied to that money's allocated or your premium put into the policy. It then has the ability to grow at a guaranteed rate of 6.75% annual compound interest for up to 10 years, or until the point at which you start the lifetime income. And to go a step further, just to show you a brief illustration of how that may work, this hypothetical scenario just gives you an idea of how that ready strategy can jumpstart the income growth. So in this example, Diane purchases this product, and her primary goal is to boost the growth of her income for her retirement. So in this example, Diane contributes $100,000, immediately receives that $25,000 or 25% bonus to that income calculation. Diane's withdrawal benefit base of $125,000 then starts receiving that 6.75 compound rate. So we're seeing it start here, and that dark blue is showing the increase with that compounding effect of that guaranteed rate. So if Diane were to wait until the 5th contract year, we can see her account balance, her income base has grown to $173,280. And that is what would be used to calculate the lifetime income guarantee. So going back, we'll take a look at the build strategy, and I'll let you run with that.
So the build strategy would be for someone that plans to delay that income out longer and really approaching that 10 years of deferral. With the build strategy, there's no income benefit-based bonus up front, but it has a stronger compound rate. So that income benefit base is going to grow at a guaranteed 9.75% compound rate for up to 10 years of deferral. And just to take a look at an example of that, there's a page in here that has a scenario. So in this scenario, the initial investment of $100,000 will grow at that guaranteed 9.75% a year from an income benefit based perspective. And one other piece to note is that if the indexes perform very well, and if in any given contract year, if the actual principal account balance grows higher than that guaranteed income benefit base, they will actually step up the income benefit base to match. And so you can see that in year 3 in this example, where the account actually grew higher than the income benefit base. So you see that step up there. And that would also come into effect if the guaranteed roll up is for up to 10 years. But let's say that someone is kind of in that late saver age range, and maybe they have longer than 10 years to delay until they start income. Well, the guaranteed growth part of it, or the 9.75, would go through the 10-year period. But beyond that point, the account will still have opportunity to earn interest. So if the account were to grow higher than that income benefit base, there's still the opportunity for that income benefit base to grow beyond the 10-year mark for some of those longer deferral periods. And so in this particular example, with a $100,000 initial deposit and the guaranteed growth plus that step up after the 10 years of delay, the income benefit base, as far as the figure, how that lifetime income is calculated, has grown to $268,510.
Yeah, so a couple different ways that this can be utilized. So earlier income versus maximizing or maximum income later. You can choose the plan based on what your retirement may look like. Now, just to be clear, one question that may come up is, okay, well, how do I select option one over option two? We're going to go over that a little bit later. It's part of defining that path of when that income would start, and then selecting the specific rider that comes with one of these two strategies. So we'll take a look at that a little bit closer later on. Let's see here. Yeah, go ahead.
Yeah, and beyond having the choice as far as how your income benefit will grow as you delay, you also have the choice as far as what will the payout look like once it begins. So there's two separate payout structures as far as how that income will be distributed. There's the level income, and that'll get you the highest starting income. So it'll start out at a very competitive amount, and that'll remain level for life. If for more of a concern about keeping up with inflation, where if you prefer the idea of having increasing income, there is also a rising income strategy. And so that'll start off at a little bit of a lower amount on the income, but then that income will increase based off of positive index performance. And you can see here.
So speaking to that a little bit, that rising income option, a little bit unique because it actually is 100% performance multiplier. So in the examples that we see here, we start with our guaranteed income withdrawal amount. We see that positive index return, and the income change matches exactly that. So we can see that the income amount increases upon that anniversary date where that crediting from the index happened. Following year, again, same situation. We see a positive return, directly impacts the income increase by the same amount. We can see that income annual amount change. This is really where I think we see the value of a fixed index annuity with that income rider, and that utilizing it for its intended purpose with the ability for the income to increase. The value we've got is that there's no change if there's a decrease or if there's a loss in that index performance. So we see that this income amount stays level, does not decrease. Same for the following year. No credit, actually a loss on the index return, but no change to that income. And then we can see that we can still continue to increase beyond that.
Yeah, and an important point here to note as well is that the principal account is protected against any market losses. So in that scenario where if the index value is actually down for the year, one, the income amount, anytime that there's a step up, that is now locked in. So there's no backslide on that income. And two, from a principal account perspective, if there's a negative index performance during the year, there would be no loss due to market activities. So in that case, it would just be 0% interest for that year. The principal is protected.
Right. Yeah. So I'll scroll back here just to recap the strategies here that this provides. So the ready strategy, where the income can start sooner, provides that bonus, which is really boosting its ability to provide a higher income guarantee in those early years of deferral. We've got the build strategy, the intention to start that income a little bit further down the road. And we'll do some comparison, some live comparison to see how that matches up on the market and how these two compare. Beyond that, you have the option to choose your income distribution strategy, whether that's a level pay where it never increases or decreases. You know exactly what to expect every month. And you have the choice of rising income strategy, which we just had a look at. In either event, you can elect single or joint coverage for all of these options. That's totally up to you. All right. Covered income, I think we're on to, yes, chronic illness. A great benefit that comes here at no additional cost, a feature that's included here is the chronic illness income multiplier. So with this, on the Truepath income, the chronic illness multiplier, it again at no additional cost, you can use this feature should you not be able to complete 2 out of 6 activities of daily living. And what am I using here? Well, what's happening is the income has the ability to double for up to 5 years should you not be able to complete 2 out of 6 activities of daily living. Now, this is all relative because when we take a look at this, if you're over 60 and unable to perform 2 out of 6 activities of daily living, Delaware Life will double that income for up to 5 years, but there must be a balance in the account to activate it.
Yeah, and that is a very unique benefit that Delaware Life is providing here. So many of these income multipliers or enhanced benefits for a care need, if you begin that enhanced payout and in between, let's say it starts and you're a year into that and it depletes the account, typically that benefit would then revert back to the standard lifetime income amount. So in this situation, you have to have some balance in there to start the enhanced income. So there could be $1 in the account. But even if that were to deplete your account in the interim, if you still have that care need for the full 5 years, Delaware Life is guaranteeing that they're going to pay the 2 times lifetime income for that full 5-year period. And then at the end of that 5-year period, it'll revert back to the standard lifetime income amount. The other piece that's unique is a lot of those benefits out there, if you have joint lifetime income with a spouse, it might be just 1.5 times. In this case, if you have joint lifetime income, it would be 2 times the lifetime income if either you or your spouse needed that coverage. Now, keep in mind, it's just a one-time use. So it wouldn't be both of you could use it for a full 5 years. It would be one or the other, but it would be the 200% lifetime income amount for up to the full 5 years, even if the account depletes in the interim.
That's right. Yep. Income goes back to where it was. Again, the ability to use that one time within that period. Awesome. All right. Next up, jump into some of the index account options within this. Let me zoom out a touch.
So yes, there's multiple options on how the principal account can earn interest. There's a fixed interest strategy for someone that they want to know exactly what to expect. They'd prefer the idea of a guaranteed interest to the account. And then there's also multiple index options where based on positive performance in the index is how the interest on the account is calculated. And you have the S&P 500 is one of the index options. There's also the S&P 500 dynamic intraday, and that is going to provide S&P 500 exposure through the E-mini S&P 500 futures. And it has a volatility control. So if the S&P 500 E-mini gets too volatile, they'll shift some of that position back into cash just to smooth that out a bit. There's also other options that are a combination of equities and treasuries. So you have the Franklin SG Select, that's a combination of equities and treasuries, as well as the First Trust Capital Strength, Barclays 10%. So that'll have US equities and treasuries. And then you have the Goldman Sachs Canopy, which is equities. It has equities, bonds, commodities, and alternatives. So that one is more of a multi-asset. So those are the different index options. And if we go down a page, there's, in particular on the S&P 500, there's a few different options as far as the interest calculation. And that can be for unique particular needs. So you have a cap strategy. You also have a participation rate that'll give a percentage of what that upside is, as well as thirdly, there's a performance trigger where if the S&P 500 is positive at all, there will be a fixed interest rate that's credited. So a couple of different ways that the interest can be calculated.
Yeah, so a couple different ways that we can use these options, different ways the interest is calculated. And then we go a step further. Delaware Life does have what they call their precision portfolios and ways at which we can apply these index options within the annuity. So in taking a closer look, they've created their own strategy, if you will, by taking the Precision Core and Precision Edge as two approaches to combining these index and diversifying the strategies. The Precision Core focuses on a foundational growth with higher allocation to the fixed account and provides a guaranteed return and steady growth. So when you're looking at an option like this, you can expect a little bit more level and steady return on the core. The Precision Edge focuses on momentum and growth potential. So a different strategy in each, just understanding that you can utilize these tools if you'd like, if we like the options that are presented to us. Also part of what we do here at Annuity Association, we do like to take a closer look and use real-time performance and understanding where the markets are today with these index options to help make the right decision. So not always are we using this. It's an option that we can do, but part of the homework that we do for you and part of the process that we take is understanding these index options, where they can add value and implementing them in your annuity.
So let's take a look at a few examples in our software. And I am going to share my screen here where we can see how the Delaware Life Truepath income stacks up in the marketplace. And also we can look at, depending on when the income begins, how does the ready versus the build strategy, how do they line up? And let me share my screen here. Okay. Zach, are you able to see my screen?
I am. This is when we get into the fun stuff. Yeah, let's do it.
Perfect. So what we're looking at, this is our software that can sort all of the annuities in the independent marketplace. And in particular, this is the income calculator where it'll sort the fixed indexed annuities in the marketplace based off of the highest guaranteed lifetime income. Now, keep in mind, these rates that we're reviewing, this is based off of June 25th, 2025. These rates are subject to change at the carrier's discretion prior to a rate lock being submitted. And also the rates, features, and availability can vary by state. In this example, we're looking at North Carolina and a 61-year-old male with an initial investment of $100,000. And we have no income reduction. So this is looking at level lifetime income. Once it begins, it'll remain level for life. And this deferral bar is where we can look at what is the guaranteed income amount based on when that begins. And so in this example, we can compare if we defer out for 3 years, 5 years, 8, 9, 10, what will that do for the income? And if we start with the 3 years of deferral, so this would be 3 full contract years have passed before the income begins, we can see here that this software is ranking all of the fixed index annuities based off that highest guaranteed income. And there's many options that are pulling here. And we can see at that 3-year mark, this Delaware Life Truepath income is showing as the highest guaranteed income for this scenario. So very competitive lifetime income with this particular product. It's showing here the annuity name, Truepath Income, and then this is showing the particular income growth strategy that's selected. So this is the Ready Growth strategy with the level lifetime income payout. And as we discussed, the Ready is more competitive for the shorter range of deferral. So if someone owned this particular annuity and planned to start income within 3 years, 5 years, a bit of a shorter period, then that Ready Growth is going to provide higher income as opposed to the build strategy. So just a couple points to note as we're looking at this. Over on the right-hand side of the screen, this is showing some of the details around the lifetime income benefit. And so we mentioned that with the Ready strategy, there is a 25% income-based bonus. So that means from the perspective of calculating your income, they're calculating that on an amount 25% higher than what was put in. And that income base is further growing at a compound 6.75% guaranteed growth for up to 10 years of delay. So that's the roll-up rate is how that income benefit grows as it's deferred. And then the roll-up period is how long can that be delayed and get that guaranteed growth. Another couple of points here, there is a 1-year waiting period before you can begin income. So any point after a year, the income can be started at any point. It's flexible. You don't have to determine that when you start the contract. And any time that there are guarantees with a contract is typically where a fee comes into play. And of course, Delaware Life, they're making a guarantee that no matter what happens with the index performance in the markets, they're guaranteeing on $100,000 that they will pay $9,397 a year for as long as the annuitant lives. And in exchange for that substantial guarantee, there is a rider fee. It's 1.2% annually, and that's calculated on the income benefit base. That fee gets deducted from the principal account. It never gets deducted from the income. So this is the actual income that would be paid out. This fee is guaranteed for the first 10 years of the contract. After that point, Delaware Life does have the ability on any given contract anniversary where they can adjust the fee. And if they do so, it would never be higher than this 1.95% maximum. So that's another important point to note. But the key thing here is that this fee is guaranteed at the 1.2 for the full initial 10 years of the contract. So at the point where they would have the ability to adjust the fee, this contract would be out of the surrender period. So if the owner was unhappy with that increase in the fee, they would have the option where they could cancel the contract and cash out their principal account balance with no penalties at that point. So just a few points to note on that income rider.
Just to be clear, Matt, on that with the fee, if that fee increases, does that increase in the fee affect the income in any way?
No, so the fee will not increase the income. The fee is deducted from the principal account balance.
Even with the increase, even if it moves up to that 1.95?
Correct.
Okay.
You got it. So this is looking at the 3 years of deferral, and we can compare a couple different scenarios just to see when the build strategy may provide a higher guaranteed income. So if we look at, let's move this up to 5 years of delay. So at the 5-year mark, it's not the very highest guaranteed income, but still very competitive. So it's in the number 2 spot. In this example, there's an option from ClearSpring that has a slightly higher lifetime income. And really, lifetime income, that's just one of the factors that we look at when we're comparing these options. There's other elements that come into play that are important. But we can see that still at the 5-year mark, very competitive lifetime income. And it's still the ready growth strategy that has the higher income as opposed to the build. Now, if we go to the 8-year mark.
Can you stay there real quick? Sorry. Yeah, you brought up a good point just in regards to our multi-point annuity inspection that we do in determining the right annuity for our clients. And they go through that process and determine what's most important to them. There's that enhancement feature, the chronic illness, which we can see right there. Yeah, we can see that actual enhancement like we talked about where that income can double should you qualify for the 2 out of 6 activities of daily living. Awesome. I just wanted to point that out.
Yeah, great points. So if we go to the 8-year mark, and so we can see the ready growth is still the highest income, and it's overall in the marketplace as of today's date, it's in the number 3 position. But now we can see just under it is that build strategy. So this one does not have the income-based bonus, but it has a higher roll-up. And so at the 8-year mark for this particular age range, we can see that it's starting to catch up where the gap between these two is pretty narrow, just within a few dollars per year. And if we move this now to the 9-year mark, I suspect this is where the build strategy would cross over and offer the higher lifetime income.
Yeah.
And so we can see here that it's overall in the marketplace, it's in the number 2 spot, but now the build strategy has the higher lifetime income. So in this particular case, it's right at that 9-year mark where it essentially crosses over, and this other strategy would result in more income. And still very competitive. So it's in the number 2 spot in the marketplace in terms of the guaranteed lifetime income.
Can we, once you're finished up on this segment here, I want to do one other thing on the same screen. Just let me know when you're ready.
I'm ready.
Okay. Can you, on the quick filter, can you just search for Delaware Life? And then can you change the deferral to 3 years? Yeah, I really want to put emphasis on the importance of working with an expert in this industry, and maybe change that to 2 years or something else. But really understanding, selecting the right product. If you just jump in and say, "Hey, I know that I want to move forward with the Delaware Life Truepath Income," we can find out that these 2 different riders offer 2 different guarantees, and they're more valuable in 2 different situations. So we can see the income amount changing based on the product that's selected. So it's just important to know that when we're looking at these, you want to work with an expert who knows what to look for in the key features of your planning, so that they can select the right product and not have a oops moment and accidentally pick the wrong one.
Yeah, that's an excellent point, because in this example, if maybe someone was looking to start income in 2 years and they were working with someone that didn't know the ins and outs of these products as well, and perhaps selected the build strategy as the rider, which that gets selected at the time that the contract inception, you can see that in this case, the build strategy is $72.99 per year, as opposed to if that ready growth strategy were selected, it's quite a bit more in the lifetime income. So that would have been an oops moment if the wrong strategy was selected in that case.
Yep.
So excellent point. I also wanted to compare, just to look for those that may be looking for joint lifetime income. So this does have the option for joint lifetime income with a spouse. And we can go through that same exercise where we compare for the joint income, where does it stack up? Of course, with the joint income, there would be a slightly lower lifetime income amount because Delaware Life is guaranteeing that for life for two people. But let's see. So if we have a spouse, they're both 61, and the income is deferred out for 3 years. So we can see that in that case, on the joint income at the 3-year mark, Delaware Life, it's still very competitive. It's in the number 3 spot, but different companies will cater to different situations, whether single life, joint life. So depending on what the specifics are, it can change the position. So we saw earlier that for the single life, that Delaware Life was in the number 1 spot as far as highest guaranteed income. With the joint, it's now at the 3-year deferral mark, it's in the number 3 spot. So that joint, it's still very competitive, but it changed its position a bit. And if we go and defer that out, we can look at 5 years. And so still in the number 3 spot at the 5-year mark.
What is interesting is we see some different carriers shift and some different carriers come to the top option. Meanwhile, it seems like Delaware is staying pretty consistent.
And then at the 8-year mark, so it's in the number 2 highest, and that we're still seeing the same thing where the ready strategy and the build, that's starting to narrow. And then we'll see at the 9-year mark is where that build strategy will cross over and provide more lifetime income. But pretty much across the board for a broad range of deferrals, we can see that this Delaware Life Truepath income is very competitive from a lifetime income perspective.
Yeah.
So now we've looked at the income side. Let's spend a little bit of time looking at the index options on how the account balance, the principal account balance, can grow and earn interest. And so there's multiple index options that we had discussed earlier, including a fixed account rate. So as of today's date, that fixed rate is 3.5% guaranteed. That is good for a 1-year period. And then if that fixed account is selected after the year passes, they would declare what the rate would be for that following year. And we're also looking at the different index options that'll credit interest based off positive performance in the markets. And what we're seeing here is this is showing the back-tested average annual returns for the last 10-year period. And it's factoring in, so these are net of these rates that are offered here, as far as these crediting rates are how that positive performance, how the actual interest is determined. Couple of points to note here is that on several of these index options, Delaware Life is guaranteeing that these rates will remain consistent for the full initial 10-year period of the contract. So that's a nice additional guarantee that's added in here. One other concept that is unique would be with this particular index here that has this boost, this 2% boost. And essentially what that's saying is if the index performs at a certain level, so in this case, if the index were to be flat for the year, so it had 0 performance, they will actually give an additional 2% that they will add in. So as long as that index hasn't actually lost value over the year, they will add 2%. and then they will apply this rate to that. So this one index strategy has some additional performance that's added in on top to what the underlying index performance was, as long as it didn't perform less than what they call the knockout, which is essentially the barrier of what that performance needs to be to receive that boost. So that's going back to the innovation with Delaware Life. They started out with offering the first fixed indexed annuity back in 1995, and they're still coming out with innovative products.
Yeah, great point.
And so another piece is that when we look at these back-tested returns, that is not where we stop the review, because sometimes you may have an index that is a little bit newer, and what happens if an index is on the newer side, the financial company that creates it, based on the components that are within that index and the rules as far as how it operates, they will project what that performance would have been had it been around for a full 10-year period. And so the back-tested returns in some case can be somewhat hypothetical. So another piece that we look at, is there real live performance from these index options that indicate that we could expect solid performance from it? And in our software, we have the ability where we look at these every day to see how they're performing, and we can look to see what the actual live performance is, or the raw index performance. So I'm going to show a report where we can take a look and see how are these indexes performing real time. So let me stop sharing here and I will pull up that report.
Yeah, so that raw index performance will strip away the participation rates, will strip away the caps, any other term which may adjust that rate and that return. And just to be clear, from our vantage point, we also recognize not everybody may understand these key terms. So if you take a look at our catalog, you will see on the Annuity Researchers, we provide some definition to understanding these index strategies and key terms, along with additional information that can help you.
Yeah, thanks, Zach. Great point. Are you able to see my screen?
Yeah, yep.
Okay, perfect. So this is a report of all of the different index options that are available in this Truepath income annuity. And as Zach mentioned, these are the raw performance figures. So these do not include some of the participation rates or caps, or some of those parameters around how the actual interest is calculated. But we can see that there's the S&P 500, the Goldman Sachs Canopy, First Trust Capital Strength, Franklin SG Select, and the S&P 500 Dynamic Intraday. And these performance figures, we see year to date, we can see the 1 year performance, 3-year averages, 5, 10, 2023, 2024, and since inception. And a couple points that we'll look for: what is the recent performance, what is the long-term performance, and what is the performance since inception. And one thing that's striking about this is that it has 3 out of the 5 that are positive since inception. You can see that year to date, there's 3 out of the 5 that are positive, as well as when you look at the 5-year average, there's 4 out of 5. So one thing that we'll look for is there the ability to diversify, where you have some index options that are somewhat negatively correlated, so that you can receive some interest in all different types of market scenarios. And this one we can see does have multiple index options that are negatively correlated, and there's still, in most periods that we look at, there's at least 2 to 3 plus that have positive performance. I know that in recent years, some of the index options that contain the bonds and the commodities, just because of the interest rate environment that we're currently in, those maybe haven't performed as well versus the more equity focused options. But when you're looking at performance, it's sometimes a fault to look at just what has happened very recently without having that long-term picture in mind. but we can see that there's several index options that have performed. So this would be just another aspect that we would compare, not only the back tested returns, but how are these index options performing real time.
Yeah, really helpful. And again, we take you through our multi-point annuity inspection process. So we take a look at these further in detail beyond what may be suggested by Delaware, take a little bit of a unique approach here and utilizing the tools that we have at our fingertips as well. But really, when we take a look at these, I think this really wraps up what we were researching here for Delaware Life and the Truepath income. So what really is standing out to me in this product is dual strategy for income, whether that's for early or later income. And there's that variable there where our clients need to determine what that time window looks like for them to find that fit. Do we take that ready now, or do we take that build approach? You also have another layer that comes with that. Do we take a level income or a potentially rising income where you can choose steady income across the board, or based on that index performance, it then credits the income calculation and can increase over time. Another element that we saw a lot of value in is that built-in chronic illness benefit. So should somebody not be able to complete 2 out of 6 activities of daily living, the income has the ability to double, provided that there is an account balance available to utilize that feature. And that feature is available at no cost. So awesome value there. We just had a look at that index performance. The index lineup is pretty solid as we look at that, as you just showed. And lastly, another feature that we just saw was competitive payouts across the board, whether that's single life, joint life, starting in 2 years, starting in 10 years. I think the big element here that we consider is what that timeline looks like and which strategy to select.
Yeah, so that wraps up our review of the Delaware Life Truepath income. If you're looking for more unbiased information about annuities and how they can support your retirement goals, or if you would like to meet with us, please check out the links below or visit our website at annuityassociation.com.
Yeah, thanks again for joining the Annuity Researchers. We look forward to sharing more unbiased annuity reviews with you in this series. So come on back. We will meet you again. Thanks so much.